Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for ChartsandMarkets.com. He's speaking to us from Vancouver. Welcome back to the show, Bob.
Yeah, Jim, always good to spend our Friday periods together, and it's been a fascinating week in the financial markets out there.
And we like to start our show off with listener questions. We have a question from Justin in Berkeley. Justin writes us, "Hi guys, I've been tracking credit spreads through the website creditspreadalert.com. Bob often looks to spreads for signs of big trouble, and this site has been tracking the slow, steady rise in spreads. Are spreads pretty much a good guarantee that the markets are under stress?"
Yep, Justin, you've got it right there. I like your term under stress because as any bull market matures, it's a standard pattern. It's not just stock speculators. There's also speculators in interest rate markets. So, and you mentioned spreads, which of course is the difference between high-grade and low-grade bonds, and in the confidence of a bull market, bond buyers will take on risk and reach for return, and it's standard stuff. And then also within this, you get the leverage going because guys in a bond trading desk or maybe their own account can borrow at a low rate, and then when you're going long at a higher rate, you're getting the spread in between. So they call them credit spreads. So that's that side, and then it kind of exhausts itself. And then the other one, which we like to talk about, is the yield curve, and that, of course, is the difference in usually Treasury market from say 6 months out to 30 years, or most people follow the 2s to the 10s, and the same thing. When you're in a speculative bull market for stocks, there will also be speculators in the credit markets, and they will be getting a return because they can borrow money at one rate and get a higher return further out the curve. So, and then of course it goes too far. So. But the interesting thing is that the yield curve seems to be the one to watch. And as I've said before, we've got on charts, we've got the curve back to 1857. And the rule is that when the curve inverts, whereby the demand for short-term money raises short products, instruments, higher than long. And then once it inverts, that's a killer, because with this history going back to 1857, every curve inversion has been associated with the boom getting over and a recession. So, and then we've noted that in great financial bubbles like in 1929 and 1873, the curve inverted twice in the year that the bubble was completing. Now, also to get to your focus on the credit spreads, quite right. In confidence in the bull market, spreads narrow, and then when they start to widen, that's a danger sign. So this is what happens in a typical bubble. And here's where I want to get back to your final word, under stress. So experienced investors or advisors will see that, hey, the curve's doing what it's doing, spreads are doing what they're doing, and then they, like in 1873 bubble, or what was the main newspaper in New York published that, well, the market's kind of under strain, nothing can go wrong because the United States does not have a central bank. It has a treasury system whereby the Secretary of Treasury can inject any amount of money into the credit markets and prevent bad things from happening. So, and this, of course, was also seen that year in London when The Economist published that, well, there may be some strains, but nothing can go wrong because the Bank of England can provide whatever credit's needed to stave off a contraction. So, and even we can move further ahead to September 2007, at the top of that, well, it was approaching the top of that terrific bull market. And a leading spokesman in Wall Street said that, well, things are looking, there's stress in the credit markets, but the Fed can cut interest rates, and that will certainly prevent bad things from happening. So there we are. You've nailed the right sector. Credit spreads are important. And in the last 5 or 6 weeks, the main one we follow, which is the CCC, low-grade stuff relative to treasuries, the move has been dramatic. And then, of course, what we've had is a dramatic sell-off in stocks. But kind of the pressures kind of got overly done this week, and we can probably have a relief period, maybe some sideways trade, maybe some bounce in whether you're looking at base metals or crude oil or credit spreads or stocks. There's a relief coming in. So, but thanks for the question.
Bob, do we have an inverted yield curve?
Do
we have an inverted yield curve happening right now?
It did earlier in the year.
And what does that usually tell us 9 times out of 10?
10 times out of 10, a recession.
Oh, so it's 10 times out of 10. There isn't even a chance that it won't happen. Interesting. We'll have more with Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, some of the headlines that caught your attention today. The first one, BlackRock abandons bullish China call for stocks with their index down 28%.
Yeah, they're a big fund manager, huge, as a matter of fact, and they remained positive on whatever sector of the Chinese stock market they were playing, and then whack, they got hit, and then they abandoned their bullish point of view. So, part of financial history.
Headline, day trader army loses all the money it made in the boom, and I think we've commented on the so-called Robin Hooders who were trading on their cell phones without any knowledge on really how the markets work.
Oh, yeah. There were many new participants to the financial markets, and that is one of the features of regular bull markets. It always brings in the general public towards the top. But in great financial manias, bubbles, man, they really come in on those ones, and they're there. And it's an old saying out of New York is that the public is not allowed to make money. What it means is that it's the public in a great bull market that really push the final price shoot up, and they're the ones that create the top. And then, of course, you get it down. So they're not, it's ironical, they're not allowed to make money. And this headline about all the day traders is, hey, that's typical.
Yeah, a TV ad I feel is almost criminal. It features a young person in their 20s. It's the TD Bank. And he says, well, I'd like to invest, but I don't know anything about it. What should I do? And his friend says, well, just here on your cell phone, you can be a trader instantly, and the bank will give you money for almost nothing to do it.
Yeah.
Well, especially.
Didn't Justin Trudeau a year ago have something, and he discovered some surefire way of making money through some tech thing and was telling people about it until until his advisors told him to shut up. So everybody gets in on the party.
Trudeau said recently, I don't know anything about monetary policy. I don't see how that's important for my job. Really? Isn't government raising money and spending money? Shouldn't you know something about money to do that?
Oh, they've become a huge influence, and they also, through the central banks, have this very weird notion that they can manage the economy and prevent bad things from happening. And they've been, well, if you take the Federal Reserve as an example, that tout has been on since the Fed was formed in 1913, that they could prevent recessions, manage the economy, and everything be wonderful. And there has been 18 cyclical recessions since the Fed was formed. I mean, that the general public goes along with this is just absurd. I mean, it's dreadful. So.
Bob, there's an election campaign going on in Ontario. In the U.S., they're in permanent election mode, and everybody's pointing the fingers at the current government, saying, you're responsible for the current inflation. Bob, is there really much governments can do about inflation, or is this just market forces at work and eventually they settle themselves out, and probably quicker, faster, and easier if the government doesn't interfere?
Yeah. In any business boom, and you've got, 150 years of history in England when sterling was on a gold standard. So you had the amount of screwing around by the Bank of England was limited, but you still had the business cycle. So on a boom, prices go up, and then on the recession, prices went down. Now, where it has been evil for the last 100 years is these theories of economic intervention through central banks, and their recipe is always, they call it anything else but it's always currency depreciation. So since the Federal Reserve was formed in 1913, the U.S. dollar has only about 3% of its purchasing power back then. So what then happens is you still get the business cycle, but the rise in prices because of the currency depreciation going on will be greater than otherwise. And then the problem comes in is that the bigger the boom, the bigger the bust. And then you add on to this the incredible phenomenon of a great financial bubble, which we're in, the greatest in history. And then this is where you get such incredible distortions in the financial markets. This time around, on previous bubbles, you can take your leading stocks, and they have, good quality, fair-sized market cap. And in a year's half time, they'd go up by 10 times and then crash. But with this Bitcoin phenomenon, these are huge market cap items, and the percentage gains have been way beyond that. Okay, so the stock side, and Bitcoin is nothing more than a stock certificate. You had huge, and then on the chronic buying of bonds by central bankers in Germany, as we've often talked, got their 10-year note down to almost minus 1%. And that's the nominal. And in all of financial history, you never had a yield instrument trading at a negative yield. So that points out that in the stock market, the greatest bubble ever, and in the bond market, that's the same thing. It just never ever happened before. So this is the government interventions in this example have been extraordinary, but you also got to understand that without the bids out there, the Fed can't be reckless. So this is where the irony comes in, is that once the speculators become exhausted, stock prices crash, which they've been hit very hard this year, and it overwhelms the ability of the central bank to keep things going. So it's interesting that the central bankers' job description lately is to keep the party going by any means. And then his nemesis, of course, is the margin clerks at brokerages or trust companies or wherever, the equivalent. And his job is to get the accounts in line. So if the theory of central bank intervention worked, it would be all one party since 1913, and there would not have been many bear markets and 18 recessions. So the fact that bear markets and recessions happen show that once the party's over, the power shifts from the central banker to the margin clerk. It's as simple as that, and this is where one of the features of the first part of this year has been margin calls out there with very disruptive results.
Headline, plunge in crypto mining stocks deepens.
Yep, that's what's been going on in the crypto stocks.
Bob, what's the story there? I know when cryptos became popular, we often discuss them being like the tulips in Holland, I think back in the 1620s.
Yeah.
That were the hottest trading item. You have to have a tulip. You have to trade it. And they were worth thousands of dollars, and then the next day, nothing.
Yeah. That was fascinating. 1637, and it just erupted with, now at that time, Holland was the commercial and financial center of the world. And they had good markets and, administrative bodies for financial markets. But the mania for tulips started by the public, and they were making markets with chalkboards in taverns. So the authorities did say and warned people that don't get into this because it has nothing to do with our proper markets. We can't guarantee clearing and all that sort of stuff. But anyways, it became the rage. They soared up, and people were leveraging and selling stuff to buy these tulips, and then they crashed. And actually, it did unsettle the money markets in Amsterdam at the time. Well, the main money market in the world was Amsterdam at the time. So, and the Tulip Bubble is still a curiosity, fascinating, and I've got a couple of books on it. But it just showed, crowd behavior, and everybody infatuated, and then all of a sudden, boom, over. The speculators became exhausted.
Suicide threats spike on Reddit after the crypto crash.
Yeah, this was the sad one, Jim. There were stories that with the 1929 crash that established men did commit suicide. They just couldn't face the change from prosperity to devastation, and it ruined their lives, ruined the family lives and stuff like that. So I think sadly these are some of these the article as I read it, there were participants sincerely talking about how dreadful their point of view was and should people do suicide and that, and it's very sad to see. But sadly, it has been part of the process. So hopefully nothing on this happens and people learn to live with their losses.
Oh, Bob, the thing about suicide is it's final. You can always come back from a market downturn. If you're alive, you can fight, you can survive, and you can get better.
Yeah.
Yeah, so many people think in the short term, but if you think long term.
Well, Jesse Livermore was one of the great traders through the early 1900s. And he at times went broke, but he always was able to come back and was an outstanding trader, made a lot of money. And under a different name, he published a book, Battle for Investment Survival, I think, or something like that. But, man, he put a lot of good stuff in that book. And in summer 1929, he knew that it was a crazy... As a matter of fact, this guy was trading his own account. He did not have a brokerage, but he had about 15 in his staff just to kind of look after things. But anyways, as you got into August 1929, he knew that there was trouble ahead. Now, at the time, there was a financial commentator, his name was Babson, and he was practical, and he'd been, bearish for too soon, and his comments would be repeated in the news media. So he knew, Livermore knew that Babson was scheduled to speak at somewhere on the 9th or 10th of September. The high was on September 3rd. So Livermore got short and then made sure that media financial types knew about Babson's forthcoming address, and so they covered it, and sure enough, Babson was bearish, and bang, that was the first hit in the stock market, and it's gone down in the literature as the Babson break. So then Livermore traded successfully all the way down, and the extreme low and dismay was 1932, and then for some reason Livermore could not get his head adjusted, and he couldn't stop playing the short side, and somewhere in the 1930s, he was destitute, and he killed himself. Very sad story, because the guy was so good. But that's what, it can happen. I knew a guy in the brokerage business years ago who was absolutely convinced on some special option deal was going on, and he was with one of the premier investment brokers, and shouldn't have been acting so recklessly, and he was long, and all his friends were long, his family and his customers and everything else were in the deal, and it crashed, and he couldn't face it, and he killed himself. So I know of one, and then in the literature there's the one about Jesse Livermore. So very sad topic, but one can always recover from being devastated in a bear market.
If you're not alive, you can't fight back.
Yep.
Bob, thank you so much for chatting with us.
Yeah, Jim, gosh, we had a range of subjects here today, but it's prompted by the wildness of what's going on out there in the financial markets.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. He was speaking to us from Vancouver. If you have any questions for Bob, you can send them to info@howestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.